There are so many great questions when it comes to retirement, particularly if you're at retirement or very, very close to it. And one of the ones that I get on a very, very regular basis is, what will my taxes look like in retirement? So I think for most of us, while we're working and we're setting up for retirement, we're setting money aside in our 401ks or our retirement plan at work, the tax part is just a function of, well, I made a certain amount of money, and then I pay tax on that money, and then I can go out and spend the income after tax. But typically the employer is taking care of that for you. So I think most of the people that we talk to are in a situation where they go ahead and decide to withhold a certain amount in tax from the paycheck every single month, and then they'll see that money hit their bank account, and then you have a comfort in knowing that, well, I can spend up to that amount of money, and because I had federal taxes withheld or state taxes withheld, if you're in a state that charges state taxes, you're comfortable, you're confident, you feel okay about spending that amount of money, and maybe you're even happy if you don't spend all of it and you're sort of setting some aside for savings. But people are often in a situation, as they make this transition from working into retirement, suddenly you're reliant on yourself to decide how much you need to withhold from your income in retirement so that you aren't writing a check to the federal government later or the state government later. So taxes in retirement are extremely important, and how much are you going to have to pay in tax? Well, it's going to depend on your situation. So one of the things I love so much about financial planning, and one of the reasons I think that I am an advocate for individuals finding an independent financial advisor that can help assist. And obviously this would be for individuals who aren't looking to do it on their own. But if an investment advisor can help you not only invest money, not only help you get a higher average rate of return, net of any fee that they were charging, or help you reduce the amount of risk in your portfolio, if they could also help you with the tax scenario, even if they're not a tax professional, but that's going to be a very, very big component to retirement or retirement income moving forward. So taxes in retirement, they look different than taxes while you're employed. You're not going to be taxed on cash in the bank. You're only going to be taxed on earnings. So think of a scenario where, well, I don't have income from employment anymore. I'll give you an example. So let's say that I'm sitting down with somebody and they tell me that they're making $200,000 from their current employer. And then let's say that they have a spouse, and their spouse is making another $150,000 in retirement. So they have a combined income of about $350,000. Well, that income is taxed as ordinary income. It's the highest tax rate you could possibly be at. And they're comfortable with that, and that they understand exactly how it works. And they're looking at their net income and, again, spending it. But let's look at somebody who's now retired. They don't have income from their employer. They're going to have income from maybe Social Security. Well, Social Security isn't 100% taxable. The question is it taxed at all? Not if you're under a certain income amount. Or is it taxed at 50%? Well, at a certain amount, it's taxed at 50%. At a certain income, it's taxed at 85%. So why do people have so many questions about Social Security and how it's taxed? Frankly, because it's confusing. Am I taxed 0? Am I taxed 50? Am I taxed 85%? Not sure. Depends on your income plan or how much income you have. What's considered income? Not money you're pulling out of savings at the bank that didn't actually earn something. A pension would be considered income. Social Security would be considered income. How are your investments going to be taxed? Well, it depends on if it's short-term capital gains or long-term capital gains. Short-term capital gains are taxed as ordinary income. Long-term capital gains are taxed as long-term capital gains. It's a lower tax rate. What about things like tax-free investments, right? What about Roth accounts? What about municipal bonds? What about things that aren't taxable? So it becomes very, very confusing for individuals that have made this transition from income from work, which is taxed at ordinary income. It's easy to understand based on if you're single, your income. If you have a spouse, your joint income. Those rates are published. They change a little bit every year. You sit down with your accountant and they just run them. You make this transition to retirement, suddenly things are taxed differently. Social Security is taxed differently, pensions are taxed differently, income from Roth versus IRA is taxed differently. Coming up with not just an investment plan, but a plan that has to do with an income plan or a tax plan. Any financial advisor should be able to sit down with an individual and put together not just an investment plan, but also an income plan and a tax plan. And that's why, we just think that anyone who's making that transition to retirement, if you can talk with an investment advisor, a licensed advisor that has a vested interest in you doing well, there's a chance they can provide value, and if they can provide value, you'll be more successful in retirement. Thank you for watching. Go to guardingyournestegg.com for your free and objective personal financial plan.